Are you tired of working long hours at your full-time job only to see a small portion of your paycheck disappear into your savings account? Do you dream of financial freedom and the ability to live life on your terms? What if I told you there was a way to earn more than your full-time job without ever having to step foot in an office again? Yeah, it starts with getting into ETFs, specifically the REX FANG and Innovation Equity Premium Income ETF, FEPI. This ETF is designed to expose investors to innovative-led companies which have the potential for significant growth and income generation. So, if you're ready to learn more about how you can potentially earn more than your full-time job through investing in FEPI ETF, keep watching. Without a doubt, ETFs have transformed the investment landscape, offering both seasoned investors and novices a gateway to the complexities of the stock market with relative ease. Unlike traditional investment methods, ETFs are traded on stock exchanges, much like individual stocks, but they offer diversified exposure to mutual funds. This unique blend of accessibility and diversification makes ETFs attractive for building a robust investment portfolio. They allow investors to buy into a broad range of assets, from stocks and bonds to commodities, without purchasing each individually. This reduces risk through diversification, making ETFs a cornerstone of modern investment strategies. In the diverse world of ETFs, dividend investing is a compelling strategy for generating passive income. Unlike growth stocks that reinvest profits back into the company for expansion, dividend stocks return a portion of profits to shareholders in the form of dividends. Investing in ETFs that focus on dividend-paying stocks provide a stream of income that can supplement or even replace traditional earnings. This approach is particularly appealing to those seeking to minimize their active participation in the market while still reaping financial rewards. And there is no better ETF to do this for you than the FEPI ETF. Understanding FEPI ETF. The FEPI ETF, or the REX FANG and Innovation Equity Premium Income ETF, represents a strategic investment vehicle for investors seeking growth and income. This ETF distinguishes itself by focusing on companies leading in innovation and technology, areas that have shown significant growth potential over the years. What sets FEPI apart is its dual strategy of investing in high-yield dividend stocks and employing options strategies, like covered calls, to generate additional income. This approach aims to offer investors a steady income stream through dividends and the potential for capital appreciation. The fund is actively managed and seeks to generate current income while exposing investors to the 15 largest U.S. technology stocks, as determined by the FANG and Innovation Index. The fund seeks to generate income by writing call options on the securities within the index, which can help mitigate the volatility associated with these stocks. The fund's focus on the FANG and Innovation Index means that it is well positioned to capture the growth potential of some of the most innovative and dynamic companies in the technology sector, including the likes of Apple, Amazon, Meta Platforms, Alphabet, Microsoft, Netflix, NVIDIA, and Tesla. Due to this, the FEPI ETF has the potential to generate high yield and price appreciation in the long term. The fund writes calls on individual stocks, not the index, which is a big plus. This means that when you write calls against individual stocks, you can generate as much as 25 to 30% per year, while the implied volatility of the index ranges around 12 to 20. FEPI's volatility as a fund sits at 10.09%, the same as the S&P 500's volatility. This means that investors holding this fund are somewhat cushioned against most of the volatility its holdings may experience. As of March 29, 2024, The fund's asset under management stood at $161.06 million. This figure reflects the fund's popularity among investors seeking to gain exposure to the technology sector while also generating income by selling call options. The appeal of the FEPI ETF also lies in its monthly distribution strategy. For investors, particularly those in retirement or seeking passive income streams, the regular dividends can provide a reliable source of income. Unlike the more traditional quarterly payouts, monthly distributions offer a more consistent cash flow, enhancing the compounding effects when dividends are reinvested. Moreover, the focus on innovative and potentially high-growth companies within the ETF's portfolio allows for an attractive balance between seeking high yields and participating in the growth of cutting-edge sectors. But what kind of a strategy should you implement for better rewards? Investment strategy. Investing in the FEPI ETF opens up possibilities for generating and utilizing dividends in ways that can significantly enhance portfolio income and promote financial growth. The dividends from FEPI, given their consistent and potential size, become a powerful tool for an investor who knows how to strategically deploy them. One common and highly effective strategy is reinvesting these dividends back into FEPI itself or other diversified ETFs or assets. Reinvesting dividends into FEPI shares a straightforward yet impactful strategy. By automatically using the dividends to purchase more shares of FEPI, investors not only increase their holdings in the ETF, but also position themselves to receive an even larger dividend payments in future distributions. This cycle of reinvesting dividends back into the ETF creates a snowball effect, where the size of the investment and the income it generates continues to grow, all without the need for additional capital from the investor. This strategy is particularly appealing for those looking to build their wealth over the long term, as it leverages the power of compounding to its fullest. FEPI offers a reinvestment program known as DRIP, allowing investors to automatically reinvest their dividends in additional shares of the fund. This strategy can help investors build their positions in the fund over time, potentially leading to exponential growth of the funds. As the value of the investments grow, so does the amount of dividends they receive, leading to even more shares being purchased and further compounding their returns. However, savvy investors recognize the importance of diversification in managing risk and enhancing returns. While reinvesting dividends back into FEPI is a solid strategy, diversifying by using those dividends to invest in other assets can provide additional benefits. This could involve purchasing shares in other ETFs that focus on different sectors, geographic regions, or asset classes, thereby spreading risk and tapping into various growth opportunities. For instance, an investor could allocate the dividends received from FEPI to purchase shares in an ETF focused on energy, emerging markets, or even bond ETF, depending on their risk tolerance and investment goals. This strategy not only broadens the investor's exposure, but also reduces dependency on the performance of a single investment or sector. For income-focused investors, these dividends represent a reliable source of cash flow that can be strategically deployed to achieve various financial objectives. Whether the goal is to grow the investment in FEPI, diversify holdings, or even fund lifestyle expenses, the dividends from FEPI offer the flexibility and potential to meet those needs. Moreover, the strategic use of these dividends can significantly impact an investor's ability to achieve financial independence and security. Now, to the interesting part. Let's say you have $50,000 you want to invest in this ETF. How much profit can you expect? A $50,000 investment breakdown. Investing $50,000 in an ETF like FEPI, known for its dividend yields and growth potential, can quickly multiply your money. FEPI offers an annual dividend yield of 10.64%. A $50,000 investment equates to an annual dividend income of $5,320. That's quite high. But here's where it gets interesting. Through the power of compounding, each dividend payout reinvested buys more shares of the ETF, which in turn will generate their own dividends, further fueling the growth of the investment. Over time, this can significantly increase the total value of the investment, transforming the initial $50,000 into a much more substantial sum. If the ETF's price appreciates by, say, 3% annually on top of the dividends, the combined effect of appreciation and compounding dividends accelerate the growth of the investment. And over 10 years, without additional funds, the investment could grow significantly, which you can now live off comfortably. Now, you might wonder, what risks are involved? Potential risks and considerations. As with any financial endeavor, investing in FEPI comes with its own set of risks and considerations. Market volatility stands at the forefront of these considerations. The prices of ETF shares, much like individual stocks, are subject to the ebb and flow of the market forces. Factors such as economic indicators, geopolitical events, and shifts in monetary policy can cause significant market fluctuations, impacting the value of ETF investments. For ETFs that focus on high-yield dividends like FEPI, market volatility can directly affect the income they generate. Companies under duress may cut dividends to conserve cash, directly influencing the ETF's ability to distribute income to its shareholders. So, how can investors enjoy the benefits of high-dividend ETFs while managing the inherent volatility risk? Before we get into that, investors should consider one more thing: the ETF's management fees and expenses. While typically lower than actively managed mutual funds, ETF fees can still erode investment returns over time. These fees, expressed as the expense ratio, cover the ETF's costs, including administrative expenses, management salaries, and operational costs. The FEPI ETF has a 0.65% expense ratio. But this ratio is always up for a change. Even a seemingly small difference in expense ratios can significantly impact long-term investment outcomes, making it essential for investors to weigh the potential benefits of the ETF against its costs. Mitigating these risks is key to achieving a stable income from ETF investments. As we had mentioned, diversification within the ETF portfolio and across different investment vehicles is a primary strategy for risk mitigation. By diversifying investments across various sectors, asset classes, and geographical regions, investors can minimize their exposure to volatility from any single source. This strategy helps balance returns over time, as gains in one area may offset losses in another. Another effective strategy is dollar cost averaging, where investors invest in fixed amounts of money at set intervals, regardless of the ETF's share price. This approach helps mitigate the impact of volatility by averaging the purchase price of ETF shares over time. Dollar cost averaging promotes a disciplined investment strategy, emphasizing long-term growth over attempting to time the market, a task known to be challenging even for experienced investors. And there you have a complete overview of the FEPI ETF. Intrigued by the potential it holds for transforming your investment landscape? Also, eager to witness how this ETF might enhance your financial horizon? Dive into the conversation below. We're keen to hear your thoughts and experiences with such ETFs. Don't forget to hit that like and subscribe to our channel for more insightful dives into the world of investing.